Welcome to our deep dive into investment failures. Understanding why investments go wrong is just as important as celebrating the wins. By analyzing past mistakes, we can uncover patterns, avoid repeating errors, and make smarter decisions in the future. In this video, we'll explore real-world examples, common pitfalls, and the valuable lessons that come from failed investments. Whether you're a seasoned investor or just starting out, these insights will help you build a more resilient strategy. Let's begin by exploring why it's crucial to reflect on what didn't work and how this mindset can turn setbacks into stepping stones for future success. When investments fail, emotions often run high. Fear, regret, and frustration can cloud our judgment, making it hard to see the bigger picture. It's natural to want to avoid thinking about losses, but facing them head-on is the first step to learning. By understanding the psychology behind our reactions, we can better manage our emotions and make more rational decisions in the future. Let's look at how acknowledging our feelings after a loss can actually empower us to move forward with greater confidence and clarity. The investment failures stem from common mistakes. These include chasing trends, ignoring due diligence, and letting emotions drive decisions. By recognizing these pitfalls, we can take proactive steps to avoid them. For example, jumping on a hot stock without research or following the crowd can lead to costly errors. In this scene, we'll break down the most frequent missteps investors make and discuss how to spot them before they derail your portfolio. Let's revisit the infamous dot-com bubble of the late 1990s. Investors poured money into internet companies with little regard for fundamentals, driven by hype and fear of missing out. When reality set in, many lost significant sums as valuations crashed. This case highlights the dangers of speculation and the importance of understanding a company's true value. By studying this period, we'll learn the risks of following the crowd and the necessity of thorough research before investing. Sometimes warning signs are present, but investors choose to overlook them. Whether it's questionable management, inconsistent financials, or unrealistic promises, ignoring red flags can lead to disaster. It's crucial to remain vigilant and trust your instincts when something doesn't add up. In this scene, we'll discuss how to identify and respond to these warning signals before they escalate into bigger problems. Overconfidence can be a silent killer in investing. When past successes lead us to believe we can't fail, we may take on excessive risk or ignore necessary precautions. This mindset can blind us to potential dangers and result in significant losses. By staying humble and recognizing our limitations, we can avoid falling into this trap and make more balanced decisions. Thorough research is the backbone of successful investing. Skipping this step can lead to uninformed decisions and increased risk of failure. By digging into company reports, market trends, and industry data, investors can make more informed choices. In this scene, we'll emphasize the importance of due diligence and how it can help you avoid common traps. Letting emotions dictate investment decisions is a recipe for trouble. Fear and greed can lead to buying high and selling low, which erodes returns over time. By learning to recognize emotional triggers and sticking to a disciplined strategy, investors can minimize the impact of feelings on their portfolios. Let's explore techniques for maintaining emotional balance when markets get turbulent. The allure of quick profits can tempt investors into risky ventures. High returns often come with high risks, and chasing fast money can lead to significant losses. It's important to remember that sustainable wealth is built over time, not overnight. In this scene, we'll discuss the dangers of get-rich-quick schemes and why patience pays off in the long run. Putting all your eggs in one basket is a classic mistake. Diversification helps spread risk and protect your portfolio from major losses. When investors ignore this principle, a single bad investment can wipe out years of gains. We'll look at why diversification matters and how to implement it effectively in your investment strategy. Trying to perfectly time the market is nearly impossible, yet many investors attempt it. This often leads to buying high and selling low, the opposite of what's intended. Instead, a disciplined long-term approach tends to yield better results. In this scene, we'll explore why market timing is so challenging and how to avoid its pitfalls. Investment costs can quietly erode your returns over time. High fees, commissions, and hidden charges add up, especially in the long run. Many investors overlook these expenses only to realize later how much they've lost. We'll discuss how to identify and minimize investment costs to keep more of your hard-earned money working for you. Herd mentality can be dangerous in investing. When everyone rushes into the same asset, prices can become inflated, setting the stage for a crash. By thinking independently and questioning popular trends, investors can avoid being caught in bubbles. Let's examine why it's important to do your own research rather than simply following the crowd. Risk management is essential for long-term investment success. Ignoring it can leave you vulnerable to unexpected losses. Setting stop-loss orders, diversifying assets, and regularly reviewing your portfolio are key strategies. In this scene, we'll highlight the importance of managing risk and how it can protect your investments from major setbacks. Leverage can amplify gains, but it also magnifies losses. Many investors underestimate the risks involved with borrowing to invest. When markets turn against you, leverage can quickly wipe out your capital. We'll discuss the pros and cons of leverage and why it's important to use it cautiously, if at all. Economic indicators provide valuable clues about market conditions. Ignoring them can leave investors blindsided by downturns or missed opportunities. By staying informed about trends like inflation, unemployment, and interest rates, you can make more strategic decisions. Let's explore how to incorporate economic data into your investment process. Taxes can have a significant impact on investment returns. Failing to consider tax consequences can lead to unexpected bills and reduced profits. By understanding how different investments are taxed, you can plan more effectively and keep more of your gains. In this scene, we'll discuss common tax pitfalls and how to avoid them. Investment scams promise high returns with little risk, but they often end in disaster. From Ponzi schemes to fake opportunities, scams prey on greed and trust. Being skeptical and doing your homework can help you avoid falling victim. We'll look at common red flags and how to protect yourself from fraudulent schemes. Investing without clear goals can lead to poor decisions and disappointment. Your strategy should align with your financial objectives, risk tolerance, and time horizon. By defining your goals, you can create a plan that keeps you focused and motivated even when markets are volatile. Let's discuss how to set and stick to your investment goals. Regularly reviewing your portfolio is essential for staying on track. Markets change, and so should your investments. By neglecting this step, you risk holding onto underperforming assets or missing new opportunities. We'll cover how to conduct effective portfolio reviews and make adjustments as needed. Inflation erodes the purchasing power of your money over time. Ignoring its impact can lead to disappointing real returns, even if your investments seem to be growing. By factoring inflation into your planning, you can choose assets that help preserve and grow your wealth in real terms. Frequent trading can rack up costs and increase the risk of mistakes. Many investors believe more activity means better results, but overtrading often leads to lower returns. We'll discuss why patience and discipline are key and how to resist the urge to constantly tinker with your portfolio. Investing in products you don't fully understand can be risky. Complex financial instruments may sound appealing, but without proper knowledge, you could face unexpected losses. Always take the time to research and understand what you're investing in before committing your money. While it's important to do your own research, ignoring professional advice can be costly. Financial advisors offer valuable insights and can help you avoid common mistakes. In this scene, we'll discuss when to seek expert guidance and how to choose a trustworthy advisor. Patience is a virtue in investing. Quick decisions and impatience can lead to missed opportunities or unnecessary losses. By taking a long-term view and allowing investments time to grow, you increase your chances of success. Let's explore how patience can be your greatest asset in building wealth. Every investor makes mistakes, but the key is to learn from them. By analyzing what went wrong, you can adjust your strategy and avoid repeating errors. In this scene, we'll discuss how to turn setbacks into valuable learning experiences and grow as an investor. Taking time to reflect on your investment journey helps you gain perspective. By reviewing both successes and failures, you can identify strengths and areas for improvement. Reflection is a powerful tool for personal and financial growth, ensuring you make better choices in the future. Markets are constantly evolving, and successful investors adapt to new conditions. Sticking rigidly to outdated strategies can lead to failure. By staying flexible and open to change, you can respond effectively to shifting trends and opportunities. Continuous learning is essential for investment success. The financial world is complex and always changing, so staying informed is key. By investing in your education, you equip yourself with the knowledge needed to navigate challenges and seize opportunities. Feedback from others can provide valuable insights into your investment approach. Whether it's from mentors, peers, or professionals, constructive criticism helps you identify blind spots and improve your strategy. Don't be afraid to seek out feedback and use it to your advantage. Keeping a record of your investment decisions, outcomes, and lessons learned can be incredibly helpful. Documentation allows you to track progress, spot patterns, and make better decisions over time. In this scene, we'll discuss how to effectively document your investment journey for ongoing improvement. Resilience is the ability to bounce back from setbacks. In investing, this means not letting failures define you. By developing a resilient mindset, you can weather market storms and stay focused on your long-term goals. Let's explore strategies for building resilience as an investor. Studying the experiences of other investors can provide valuable lessons. By analyzing both their successes and failures, you can gain insights that help you avoid similar mistakes. In this scene, we'll look at how to learn from the journeys of others and apply those lessons to your own strategy. Patience is often undervalued in investing, but it's crucial for long-term success. Markets can be volatile, and quick reactions can lead to poor decisions. By maintaining patience, you give your investments time to recover and grow, increasing your chances of achieving your goals. Unrealistic expectations can lead to disappointment and poor decisions. It's important to understand that investing involves risks and that returns are not guaranteed. By setting realistic goals and being prepared for ups and downs, you can avoid frustration and stay committed to your plan. Discipline is key to sticking with your investment strategy, especially during tough times. It helps you avoid impulsive decisions and stay focused on your long-term objectives. In this scene, we'll discuss how to cultivate discipline and why it's essential for investment success. Every investment involves a trade-off between risk and reward. Striking the right balance is crucial for achieving your financial goals. By understanding your risk tolerance and adjusting your portfolio accordingly, you can pursue growth while protecting your capital. Adaptability allows you to respond to changing market conditions and new information. Rigid strategies can lead to missed opportunities or increased risk. By staying open to change and willing to adjust your approach, you can navigate uncertainty more effectively. Complacency can creep in after periods of success, leading to overlooked risks and missed warning signs. Staying vigilant and regularly reviewing your investments helps you stay proactive and avoid unpleasant surprises. Let's discuss how to maintain a healthy level of caution, even when things are going well. Compounding is one of the most powerful forces in investing. By reinvesting earnings and allowing your investments to grow over time, you can achieve exponential growth. However, frequent losses or withdrawals can disrupt this process. We'll explore how to harness the power of compounding for long-term wealth. History is full of investment booms and busts. By studying past events, we can identify patterns and avoid repeating mistakes. In this scene, we'll look at how historical perspective can inform your investment decisions and help you navigate future challenges. A well-defined investment strategy provides direction and discipline. Without a clear plan, it's easy to get lost in the noise of the markets. In this scene, we'll discuss how to develop and stick to a strategy that aligns with your goals and risk tolerance. Investing is a journey of continuous improvement. By regularly reviewing your approach, learning from mistakes, and seeking new knowledge, you can enhance your skills and achieve better results. Let's explore how to make ongoing improvement a core part of your investment process. Staying motivated during tough times is essential for long-term success. Markets will have ups and downs, but maintaining a positive outlook and focusing on your goals can help you persevere. In this scene, we'll discuss strategies for staying motivated and committed to your investment journey. As we wrap up, remember that every investor faces setbacks. The key is to analyze failures, learn from them, and use those lessons to build a stronger future. By staying disciplined, patient, and open to learning, you can turn past mistakes into stepping stones for success. Thank you for joining us on this journey to understanding and overcoming investment failures. Here to smarter, more resilient investing ahead.